What's up, everyone? We're going to walk through today the power of uninterrupted compounding and why the Allianz IUL serves as part of the foundation of my wealth growth strategy, even more so than my Roth, my traditional retirement accounts, and my brokerage. The Allianz IUL is part of my foundation, and that is due to the power of uninterrupted compounding. So we're going to walk through a comparison of the S&P 500 index returns versus the indexing strategies based on the current participation rates of the Allianz IUL. It's going to be really interesting. Stay tuned. Let's get into it. The first indexing strategies that we're going to look at are based on the Bloomberg US Dynamic Balance 2 ER Index. And it's a mouthful. The ticker symbol is there on your screen. Basically, this is going to reallocate based on historical volatility between a large cap index and a bond index in order to control that volatility and really target around a 5% return for the actual index. But that's not really what's interesting. The thing that's interesting is how that actually applies to your policy. And so that's what these indexing strategies are right here at the top. So as we look at these indexing strategies, you may notice that we have the concept of a participation rate and a bonus on some of these. And some are just purely participation rate. And also, in this case, this bonus is actually applied different than these other two. So let's discuss. In order to get this 40% bonus on top of this 180%, so that's how when you look at a year that did 14.73% in 2017, you get 180% times the base index return, and then you put 40% on top of that. Then there's a 1% annual asset charge that is also subtracted from that, and that is applied here. So in a negative year, you could potentially see a negative 1% decline if you're using this indexing strategy. But in the end, this is one of the strongest strategies. It's where I most heavily allocate my IUL, and for good reason for the most part. We'll get into that in another spreadsheet that I have that walks through what is the break-even point for each of these indexing strategies, which one is going to be the strongest. And so that's where you can really establish, or do you think that on average the return of the index is going to be better than that break-even point or worse? So that's how you determine these things. And so the bonus strategy here is similar in that it has the participation rate. So in this case, the bonus strategy is a higher participation rate than the select strategy. So this is select, and then this is bonus, and then this is classic and standard here. So this is a higher participation rate, and it has a 15% bonus. So that will be the 190% will be applied to the return, and then on top of that, 15% will also be applied to that 190%. So that's how you can have a 6% index return, and that turns into a credit of 13.36. This does not have the asset charge, so in a negative year, this will give you a 0% return. The classic is a little bit different. So this is where really the biggest change to these indexing strategies is this classic is becoming much more attractive. So really a pretty impressive participation rate, and then your floor becomes this 0.9%. So the thing about it is, by having this guaranteed 0.9%, you're giving up some returns on the stronger years. So comparatively, okay, in 2005, you might have had a 0.9% return as opposed to a negative 1% return on the select strategy. But realistically, you can see that in 2017, you're looking at a difference of almost 7%. So it's almost 7% difference in the 2017 return. So that break-even point between those strategies, we're going to get into that in a little bit later. And then mathematically, the standard is exactly the same as the bonus. So you'll see that these returns are exactly the same. And I'm showing all of this because I have all of this in a spreadsheet that we're going to actually walk through in comparison to the S&P 500. And So we'll get into that here in a moment. All right, next we're looking at the PIMCO Tactical Balanced ER Index. Again, this is a volatility controlled index. It's looking to control volatility by mixing large cap and bond futures. So this is a similar index strategy to the Bloomberg. Both of these, because they're volatility controlled, are the strategies that have uncapped returns, and that's why they're really advantageous for people who are looking to have uncapped returns and really good downside protection. So I didn't cover it too in depth in the Bloomberg section, so I really want to highlight that this 0.9 bonus is applied different than the 15% bonus and the 40% bonus. The 40% bonus and the 15% bonus are both multipliers, where the 0.9% bonus is an addition. So that's why a year that was a negative 2.18 return would be giving this 0.9% return. So in the end, the classic index strategy is going to have the best downside protection. You're never going to have a 0 year. So there's also insurance costs. So it depends on whether or not that is a factor. But in terms of the index crediting, you're never going to have a 0 year. And so the thing that's a little bit different with the PIMCO, and it's likely because the options for the PIMCO are a little bit more expensive, the participation rates aren't as good. So you'll see 180, 185, 190, and 212.75. And we're going to get more into that specifically in the spreadsheet where I break down the comparisons of which strategy is going to be the most advantageous when it's break even. So it really just depends. Historically, the select strategy has been the strongest when you look at historical averages, but it's not to say that that's going to be the case in the future, and especially as they've made this classic strategy stronger than it has been in the past, it might be something that's worth looking into. I'm not currently allocating. I currently split between these two strategies. So one good reason, though, you can split between a number of strategies is to have more opportunities to use the Allianz lock feature. So if you're seeing a decent return in a given year and you're happy with it, you could go ahead and lock one of your strategies and let your others shoot for those big returns. It's sort of timing the market, but if you're really paying a lot of attention and you're looking at the macro economy, it might be something worth doing if you're paying attention to all those things. Real quick, I just want to cover that the historical returns for the S&P that I'm going to walk through on the spreadsheet, it was just pulled directly from Investopedia's data here showing the historical returns, and this is just calendar year returns. So at any given point in a year, you might have different returns. So this is just for comparative purposes because the indexing strategies that we're going to walk through in comparison are all based on historical returns for the calendar year, and that's what we're basing it off of. So I'm just going to scroll through, and you can see these different returns over the years, and we'll jump into the spreadsheet now and take a look to compare the S&P 500 returns with the returns of these indexing strategies. As I said, the values on this sheet are pulled from that Investopedia. So this column B is based on Investopedia's data on returns for the S&P for the calendar years. We're starting this in 2005. So for context, this is not to the advantage of the S&P. In 2005, we're going into or about to go into a pretty big recession. It's in the middle of what's called the lost decade. So take a lot of this with a grain of salt. It's just a representation of a snapshot of time. The reason I'm starting there is not to advantage these indexing strategies. It's really just because that's how far these index funds, these volatility controlled index funds, go back. The Bloomberg and the PIMCO started out having data in 2005. So in order to have an apples to apples comparison, that's where I'm starting. And as I said, this disadvantages the S&P. So understand that as we go through this. But, honestly, our system sort of revolves around booms and busts. So it could be that these scenarios will happen again. And it's hard to say what exactly will be the long-term performance of these strategies versus the S&P, but I think that these strategies will come out ahead over the long term. So not going to talk through every single number, but you can see that in 2008 the S&P had negative 36.55%. And then when you look at the actual Bloomberg index return, because it's volatility controlled, the index does not go down to that same degree. So you can notice that here. And so this column C is the actual Bloomberg return, and column H is the actual PIMCO index return. So these are all just shorthand for what the previous what I went through on the previous document. So I'm just going to refer to them as the Bloomberg and the PIMCO. And then these other columns are, the select, bonus, classic, and standard. These are the different indexing strategies using that participation rate and that bonus strategy, or the bonus multipliers or addition in the case of classic, and then standard is just participation rate. So these are what the hypothetical returns would be considering for the current day participation rates. And also keep in mind, those participation rates can adjust. The Allianz, in this case, will adjust them up very quickly when the environment is good. They adjust them up, but they could adjust them down in challenging circumstances where options get expensive and where interest rates are low. So those are circumstances where you might see participation rates come down a bit. But generally speaking, they're not going to swing super crazy. It's just they'll come down, a little bit, and then they'll bring them back up as the interest rate environment or the call options improve. So to cover a couple of other time periods was that 2017 year. So in the case of the S&P directly, we're looking at a 21.61% return. But you can see this Bloomberg Select strategy was a 36% return, and this Bloomberg PIMCO Select strategy was 35.44. So even on strong years, the indexing strategies can outperform the S&P. That's not going to be the case on every year. It just depends on what the circumstances are. So you can see that 2019 was more comparative. We've got the Bloomberg Select only coming out slightly ahead, and the PIMCO Select behind the S&P return in 2019. And to look at a different year like 2013, so the S&P did 32.15, but the Bloomberg Select is at 19, and the PIMCO Select is at 18. So it just goes to show you that these are different than the S&P returns because they're using different strategies. The indexes themselves for the Bloomberg and the PIMCO are volatility controlled. They're moving between large cap equities and bond futures. So it behaves a little bit differently. So it's a monster year in the S&P would not necessarily be a monster year for these index strategies, and vice versa. So some monster years for these index strategies may only be okay returns for the S&P. So with all that said, let's look at how the data actually compares. Right now, Allianz is automatically upgrading. If you can get standard health rating or above, you get upgraded to the Preferred Plus top health rating. So if you're interested in getting started, now is a good time to get an Allianz IUL. Check the video description to book a meeting with us. Also, if you're interested in whole life, that is another great foundation for wealth. I implement that in my own life. You can book a meeting with us to discuss that and see whether the Allianz IUL or other IULs or whole life is better for your situation. Check the video description to book a meeting. Love to work with you. All right, so let's jump into this chart. Now, again, I want to caveat that this disadvantages the S&P 500 because in 2022, it was a big negative year. So you can see this is an minus 18%. So 2022 does not look great. It brings down the balance. But just looking at the comparison, still 2021, and in this big bull market, it's still behind these indexing strategies for all of the indexing strategies. Now, the bottom here are the actual returns of the Bloomberg and the PIMCO index. Those are before any of the bonus or participation rates. This is just the direct index returns. So those are the lowest. But that's not has nothing to do with the strategies that are implemented in the Allianz IUL. So in comparison with any one of the indexing strategies that we have access to in the Allianz IUL, the S&P comes out behind, even after a very big bull market. So 2021 is a very long bull market, and each of these strategies comes out ahead. And you can see that the overall return is highest on the two select strategies. And then you can see that standard kind of comes in behind it. And there's the different mixtures of the classics. The classics are on the lower side. So over the long term, based on this 2005 to 2022 returns, the select strategies are significantly ahead, and that's why I allocate most of my funds in my IUL to these select strategies, because I can deal with having a possible negative 1% year, and then look at the returns for the monster years or the big years that are really advantaged. And so over the long term, on average, I feel like they're going to come out ahead. But I still do a smaller subset of the funds in my IUL into the bonus strategy to, one, have an extra index lock opportunity, and two, to have the ability to diversify and still have a little bit of that downside protection, or a little bit more of that downside protection. So this chart that we're looking at here is driven by this table here below, which is using the math of all of these returns above to apply it to this $100,000 initial principal. So based on a $100,000 initial principal, what you can see is the S&P return at the end of 2022, or the balance would be $448,000 versus $703,000 for the Bloomberg Select, almost $704,000, and $715,000 for the PIMCO Select. Past performance is not necessarily going to, make for the future performance, but this is sort of an indicator of what you might be able to expect. And so with that, you can see that these strategies were not as negatively affected between the in 2021, these index funds went down. So in 2021, if you look at, in 2022, the Bloomberg did have a negative 12%, and the PIMCO had a negative 2.27%. So there was a bad year for those index strategies. However, you don't actually lose that, because when you have the select strategy, your floor is that negative 1%, or these other strategies are either 0% or 0.9%. So that's why these are not as impacted, and this is what I mean by uninterrupted compounding. So you don't step back significantly in any given year when you use these indexing strategies. And the way that they do that is they're buying options, call options against these index funds, and that's how they're able to do that. So if the index goes down, the options will expire worthless, but if the index goes up, they have exposure to those gains. So that's an important factor on how these returns end up not being impacted as much. So you can see that whereas the S&P, even though the starting balance in 2021 was less at $546,000, it went down by almost $100,000 in 2021 to 2022. So that's a big drop. Whereas the Bloomberg Select, it went down $7,000, starting with a higher amount, and the PIMCO Select went down about by $7,000 as well. So that is the real power in using these index strategies, and it's really why I think this is the foundation of my own wealth growth, even more so than my Roth, even more so than my brokerage accounts, even more so than really anything. So that it's extremely powerful when you don't have compounding interrupted. Now we're going to break down where the break-even point is for the different indexing strategies for an Allianz IUL. So you can see here we have the participation rate column and the bonus column and the return rate. So this would be the return rate of the underlying index, and the return after the bonus and participation rate. And then a couple of the strategies do have the asset charge, so that will get subtracted out. And then the total cash value based on what is the initial cash value after you apply the entire return. And the return rate is going to be probably where it's easiest to make these comparisons. So you can see based on the return rate of the underlying index, if the index does 2.65%, this would be the effective return rate of the indexing strategy based on the participation rates, the asset charges, and the bonuses that are on top of that. So at 2.65, we can see that the select strategies, both of them come out behind. And you'll notice too that I have this 40% bonus, 1% asset charge, and 40% bonus, 1% asset charge. Both of those represent the two different Bloomberg or PIMCO index strategies. In this case, they're both the same participation rate, so there's no difference if the underlying index does the same. But because Allianz currently has Bloomberg ahead on things like the bonus strategy, this 15% bonus has a higher participation rate to represent what would be the Bloomberg return. And then same thing with the classic strategy. So this 0.9 has a higher participation rate. So that's shown here. And the standard strategy has no bonus, but just pure participation rate. It has a higher participation rate. So that's what all of that represents. So with a 2.65% return, we can see that the highest return is the Bloomberg classic strategy. That is the winning strategy if the index does 2.65%. You have a return rate of 6.07, and the effective end cash value is slightly higher. It's not a huge difference, but so the numbers here are small. Now let's walk through and see at what point does that actually change over. So also right now we can see that the select strategies are the worst in this case, except for this one standard no bonus, and so the two PIMCO bonus and standard options are behind. So that's the weakest at 2.65. So we can actually, let's adjust that down to see at what point that changes over everything. So still slightly ahead with the select strategy. So it's probably 2.6 flat. Nope, not even. So it's 2.59. Oh, let's go down to 2.55. Okay, so 2.55 is where the select strategies end up equaling the PIMCO bonus or standard options. So you can see 5.43, these are effectively equal. I mean, it's not exact because if you look at the actual cash returns, it's really close. So that's basically the cutoff point for that. Now, we want to see at what point does the select strategy overtake all of the other strategies. So let's go to 2.9%. So 2.9%, the select strategies are still behind the Bloomberg bonus strategy and standard, and the classic is still ahead. So we can see that is the case. So it's pretty close to what would be the PIMCO classic. Let's go ahead and go a little bit over 3. So 3.125. And we can see now that the Bloomberg is still behind the higher classic strategy. So at 3.13, 3.125, it's higher than the lower, so the PIMCO classic strategy, but it's not as high as the Bloomberg classic strategy. So let's go a little bit higher and go to 3.15. Still not there. Let's go to 3.2. Still not there. So the cutover that we're looking for is between the rows 2 and 3 compared with row 6. And let's go to 3.3 and see whether that does it. Pretty close. So I think it's going to be 3.35. Yes. So at 3.35, the select strategies do overtake the classic strategy for the Bloomberg index. And that's where the select strategy becomes the highest. And so when the underlying index is targeting that 5%, and it's a volatility controlled index, the chances are that it's going to outperform this rate. And that's why I most heavily use the select strategy. So it's not that it's always going to. There are going to be years where the classic will be the strongest. There might be years where the bonus is also a bit stronger than the classic. So this is why you can split between a number of these strategies, and based on your risk profile and what you want to do. But in the long term, it's quite likely that the select strategies will still be the strongest, even though the classic has increased the participation rates and it's really becoming very competitive. Now, in the end, I might end up reallocating some to the classic strategy because it is becoming very attractive, and on those weaker years, then it still might be to your advantage to use that. But the difference becomes really apparent when you increase these returns significantly. So let's go to a 10% index return. This is not going to be super common in a volatility controlled index, but it's possible. And so we saw where that break-even point is, that it really is effectively nothing at that 3.35% return. But at 10%, now we're starting to see actual numbers differences that result in effective differences in your gains. So based on a $100,000 cash value, we're looking at thousands of dollars of difference. So the classic strategy is $120,400 after the return is calculated in, and the select strategies are at $124,000. So this is almost a $4,000 difference when you use this strategy. And these things can compound. So when over time, as time goes on, the compound interest will gain. So that's really why using the select strategy, if you're in a lower risk class, or if you're younger and you're not necessarily relying on income and all that stuff, these select strategies can result in higher returns to affect bigger balances in the end and increase compounding. So, but at the same time, it still can make sense, because it's not like these classic strategies are not going to give you good returns. In a 10% year, a 20% return. So the underlying index is 10%, and the classic strategies have returns around 20%. That's still really good. So that's you can make the determination for your situation, and we can have further in-depth discussions to see which strategies will make the most sense for you. But for my case, I do still most heavily go with the select strategy. I hope you enjoyed this walkthrough. It does take a lot of effort to create these comparisons, create these spreadsheets. So drop me a like if you enjoyed the video. If you're looking to learn more about the net wealth finance strategy, then check out this playlist. You can also check out this video here for other information. Thanks for watching. We'll catch you in the next one.